Hey everybody, Marty Mazur, good afternoon. It's the 6th of December 2016. I'll try to keep this one quick. You have the 1-year daily S&P 500 chart in front of you. I've been showing you this trend line that connects February low through the Brexit low and then became resistance as we broke down below it, stayed there for a while, got above it, came back below it, and today closed just above the trend line. Folks, technicians spent a lot of time tracking longer term trends. This would be let's call it an intermediate term trend for the market, and actually placing short-term trades along trend lines. So here we'll see if we get some momentum. I'd say that's just right smack dab on it. Sometimes the technicals explain market and action when maybe the news does not. Let's go back a little bit and talk about all-time highs. Here we shot through this. I shared with you here that there was a great deal of bearishness that could actually turn bullish and push the market sustainably into all-time highs, which seems to be the case, barring a few tests along the way. I remember right here a very, very popular mainstream media, financial media, if you will, technician said, sell this thing, it's not going to last. Well, turned out that probably wasn't good advice, certainly not for long-term investors. Had at least one person reach out to me here, a trader friend of mine, who wondered if I thought maybe we should short the market or he should short the market at this point. And I said, no, that's not what I would do, given certainly the technical indicators that I was tracking. There's nothing that suggested that we should be bearish just because we moved through that 2015 all-time high. And you can see we stalled out just below 2,200 on the S&P and then came out above it and now seem to be dancing along this trend line. There does seem to be something about sentiment around new highs. In fact, I had clients recently who had new capital suggesting that there's just no way this can go higher. Well, history tells somewhat of a different story. Here is from a presentation. I'm borrowing this from Chris Shavacco. He does a very good technical analysis of the market every weekend on YouTube. It's about a half-hour presentation. I take it in most weekends. And this last weekend, he did actually focus on previous all-time highs from 1982 through 1999 and made the very good point that anybody who thinks that simply because we hit an all-time high that the market has to fall apart. Of course, there were some periods there where it looked like maybe that was happening, but if they are long-term thinkers, boy, and started thinking short-term because of this, it could have been very, very costly, at least during the 90s. Also, I've been talking a lot about consolidation boxes or phases because we've been in one, very frustrating one, but they're all frustrating. And here's that same period when you can throw these rectangles on top of areas that no doubt were very frustrating for investors at the time. And I pointed this out, well, not every time, but much of the time, these consolidation phases, the market tends to break out to the upside. And the one point that Chris was making is that the longer the consolidation phase tends to set the stage for a longer rally to the upside. I'm not promising anything. I have shown you the box that we're in. I've shown you moving average and things that tell a pretty compelling story about a positive future, but the market can change on a dime and it can surprise us. That's why we are never, ever short-term investors with the serious money in our portfolios. If you look at really long-term consolidation boxes, 1937 through 48, 66 through 74, this is a very frustrating time. I know for a fact that the Dow was at the same place at one point in 1982 that it was at in 1966, and people pointed that out to me when I tell them that generally speaking it's good to be in the market long term. Well, when we have these long-term sideways channels, and of course these do not take any account of dividends that are paid during this time, this is just the movement in the index, tends to be that the market enjoys a good time. And here we are breaking out of this very long one that basically encompassed the tech bubble bursting and then the real estate bubble bursting. No telling where we go from here, but the history could make one optimistic if one wanted to be. The economy. I've been suggesting lately that the indicators are looking up, and certainly the Institute for Supply Management. This is a monthly survey of around 400, in this case, manufacturing firms. And what do they think about the future? They talk about new orders, backlogs, employment, and so forth. Anything above 50 is considered expansionary. You can see the November survey was 53.2, which was above the high end of economists' expectations, which speaks well of the manufacturing sector now and going forward, at least for the next few months. Same thing for services. 57.2 is a very high reading, again, above the highest range in terms of the economist consensus. So the ISM, I know this is tracked very closely by currency traders. This would be bullish for the dollar. I've got some my own opinion on where the dollar goes from here, which I'll share with you at another time. I want to fold in bonds real quickly. As you know, and I talked about this the last 2 weeks, bonds have really beginning to hit pretty hard here. Let me come back to that one. Here's the 1-year chart. And this is the 1-year daily chart. You can see bonds really began giving up the ghost back in July, and that's been a very precipitous drop. And I know there's a lot of retirees out there, not our clients, thankfully, but a lot of retirees who thought they were safe in bonds, but did not seem to understand that they can be exceedingly interest rate sensitive. And just because they've been able to buck the trend of very low interest rates, and the central banks of the world have helped out immensely, doesn't mean that ultimately they don't begin to make sense. And this makes a lot of sense to me. The question is, what do the longer term charts, what do the technicals tell us? Well, when you look at it on a 5-year monthly basis, you can see that we've failed to come back to that trend line. It was a little bit of a higher high, but you can see again, this is a very smoother looking monthly chart. It's rolled over. Well, the moving average convergence divergence, or the MACD, which is a momentum oscillator I've introduced to you before when looking at the stock market. This is a very bearish look in terms of what it says about momentum in the bond market. Doesn't mean that bonds are going to have to go a lot lower, that they couldn't bottom and go higher. But for that to happen, we're going to have to see less favorable economic data. And right now, as we sit here today with all the information we have at our disposal, the economy looks like it's gaining some traction, so we should see a little inflation this coming year with some higher interest rates, and that's not a good scenario for bonds. I will be looking for an opportunity, those of you who are our clients out there, particularly you retired folks, to find good individual bonds, not bond funds, mind you, but individual bonds with good ratings, with good yields, but they're going to have to give up more of the ghost, if you will, before we get too excited about them. This bond market has a lot of correcting to do, I think, going forward before it begins to make sense, and there's true value there. But we'll wait and see. Like as I will on the equity markets and the economy, I'll keep you up to date on the fixed income markets as well. Thank you, folks, as always, for watching and listening, and I'll be back very soon. Take care.